The greatest financial empire of the internet age is crumbling before our eyes. For 2 decades, PayPal was the undisputed king of online money, a titan that processed trillions of dollars and birthed the careers of Elon Musk and Peter Thiel. But today, that king is bleeding out. From a staggering stock price of $300 in 2021, the company has lost over 80% of its value, trading near $60 in 2025. This is more than a market correction. It is a mass exodus. Millions of users are abandoning the platform, merchants are ripping out the payment buttons, and trust has evaporated. The story of how this fintech monopoly lost its crown warns every tech giant on Earth.
Understanding the magnitude of this collapse requires looking at the foundation. In the early 2000s, PayPal was more than a company. It was a revolution. Founded by the legendary PayPal Mafia, including Elon Musk, Peter Thiel, and Reid Hoffman, it solved a problem that banks were too slow to touch, sending money over the internet. They survived the dot-com bubble, fought off fraudsters, and eventually sold to eBay for $1.5 billion. For years, they were the only option available. If you wanted to buy something online without typing your credit card number into a sketchy website, you used PayPal. That monopoly created a culture of arrogance and a belief that they were necessary to the internet economy. But as we are seeing in 2025, no one is too big to fail. The numbers tell a brutal story. In July 2021, during the peak of the pandemic online shopping boom, PayPal's stock hit an all-time high of $308. Investors treated it like a technology god, valuing the company at over $300 billion. Then reality hit hard. As the world reopened and competitors gained ground, that valuation collapsed. By late 2025, the stock is languishing around $61. That is a catastrophe rather than a dip. They lost nearly $300 billion in market value, more than the entire value of companies like McDonald's or Netflix. Long-term shareholders saw their wealth incinerated, and the market signaled that it no longer believed PayPal was the future of finance. The bubble exploded rather than leaking. Trust takes years to build and seconds to destroy. For PayPal, that destruction happened in October 2022. A policy update leaked that appeared to grant PayPal the right to fine users $2,500 for promoting misinformation. The reaction was explosive. The idea that a payment processor could seize your money because they disagreed with your speech terrified users across the political spectrum. Although PayPal quickly walked it back, claiming the language was an error, the damage was permanent. A viral delete PayPal movement swept social media, and searches for how to cancel accounts spiked by over 1,000%. It was the moment millions realized their digital wallet was not a bank account, but a permission slip that could be revoked at any time. The most terrifying aspect of the PayPal experience is the infamous 180-day hold. Countless small business owners and freelancers have woken up to find their accounts locked and their funds frozen for 6 months, often with vague explanations about suspicious activity. In 2022, a class action lawsuit led by users like Lena Evans and Roni Shemtov exposed this practice. They alleged that PayPal seized hundreds of thousands of dollars from their accounts without due process. These were yoga clothing sellers and charity organizers rather than criminals. The lawsuit highlighted a terrifying reality. When PayPal freezes your money, you can't walk into a branch and talk to a manager. You are at the mercy of an algorithm, waiting half a year to access your own livelihood. This reality has driven thousands of merchants to safer shores. For 15 years, eBay and PayPal were inextricably linked. If you bought a vintage watch or a used video game on eBay, you paid with PayPal. It was the engine of their growth. But in a move that signaled the end of an era, eBay decided to break up with its former subsidiary. They switched their primary payment processing to Adyen, a Dutch competitor that most consumers had never heard of. By 2024 and 2025, the migration was complete, and the impact was devastating. PayPal lost access to one of the largest marketplaces in the world as its guaranteed default option. eBay sellers, once PayPal's most loyal army, were forced onto a new system, proving that PayPal was no longer the necessary utility it once claimed to be. While PayPal was fighting PR fires, a sleeping giant woke up and took over the industry. Apple Pay has become the default way millions of people pay for everything, from groceries to online subscriptions. By 2025,
Apple Pay holds a staggering 92% of the US mobile wallet market. The difference in experience is painful. With Apple Pay, you double-click a button on your phone and your face verifies the purchase instantly. With PayPal, you are often redirected to a separate window, asked to log in, and forced to click through multiple confirmations. In the smooth economy of 2025, those extra seconds are fatal. Apple integrated payments directly into the operating system, making PayPal's third-party app feel like a clumsy relic of the desktop era. If Apple Pay stole the consumers, Stripe stole the businesses. Ask any software developer in 2025 which payment system they prefer, and the answer is almost universally Stripe. While PayPal rested on its brand name, Stripe built a better engine. They offered clean code, better documentation, and a system that allowed companies to keep customers on their own websites instead of redirecting them to a PayPal login page. Today, 78% of SaaS companies run on Stripe. They quietly powered the infrastructure of the internet, while PayPal was busy trying to be a consumer super app. Merchants realized that using Stripe meant higher conversion rates because the checkout flow was smoother. PayPal became the alternative payment method, the secondary button you add just in case, rather than the foundation of your business. Visit PayPal's Trustpilot page in late 2025, and you will see a sea of one-star reviews. The common thread is the total absence of human support. As the company cut costs to please Wall Street, they replaced customer service agents with chatbots and automated loops. Users describe the nightmare of trying to resolve a hacked account or a failed transfer. They call numbers that lead nowhere and chat with bots that paste generic links. In an industry dealing with people's money, silence is unforgivable. When a bank locks your account, you can visit a branch. When PayPal locks your account, you are screaming into the void. This collapse in service standards has destroyed loyalty. People leave PayPal because they are forced to out of frustration rather than by choice. PayPal owns Venmo, which was supposed to be their crown jewel for the younger generation. But they ignored the threat coming from the traditional banks. Zelle, a network owned by major banks like Chase and Bank of America, has crushed the competition in volume. By 2025, Zelle is processing over $1 trillion annually, dwarfing Venmo's numbers. The advantage is obvious. Zelle transfers are instant and go directly bank to bank with no middleman holding your funds. With Venmo, you have to cash out and wait, or pay a fee for instant transfer. Zelle is free and instant because the banks run it. PayPal finds itself in a war where its competitor's product is built directly into the banking apps that everyone already uses, making Venmo less necessary by the day. As the market races towards zero fees, PayPal is still charging like it is 2010. Merchants are tired of the standard 2.9% plus 30 cents per transaction. But the real anger comes from international fees. If you try to convert currency or accept a payment from another country, PayPal's fees can skyrocket to 4 or 5%, hidden in poor exchange rates. Competitors like Wise and Revolut exposed this by offering the real exchange rate for a fraction of the cost. Users in 2025 are financially literate. They check the math. When they realize that PayPal is taking a massive cut just for moving digital numbers from one column to another, they switch. The convenience fee model fails when the alternatives are both more convenient and cheaper. PayPal's fraud detection algorithms are legendary, but for all the wrong reasons. In their attempt to stop scammers, they have cast a net so wide it traps thousands of innocent users. A sudden increase in sales, a login from a vacation location, or a transfer to a family member can trigger an instant automated ban. The system is designed to shoot first and ask questions later. For a casual user, this is annoying. For a business, it is a disaster. We have seen reports of Twitch streamers, artists, and small shops losing their ability to process payments overnight because an AI flagged their growth as risky. When security becomes a liability, users stop feeling safe and start feeling targeted. The most visible sign of PayPal's decline appears on the checkout page itself. 10 years ago, the yellow PayPal button was the main call to action on every website. Today, it fights for space in a crowded row of icons. You see Apple Pay,
Google Pay, Amazon Pay, and buy now, pay later options like Klarna and Afterpay. Merchants are deprioritizing PayPal because it often has lower conversion rates. Every time a customer has to remember a password or deal with a two-factor authentication text message, they are more likely to abandon the cart. Newer wallets use biometrics on the device, skipping the login entirely. PayPal is becoming the dial-up internet of payments. Solid and familiar, but painfully slow compared to the broadband speed of its rivals. In late 2023, PayPal brought in a new CEO, Alex Chriss, to stop the bleeding. By 2025, his strategy has been a mix of cost-cutting and promises of profitable growth. He launched features like Fastlane to speed up guest checkouts, trying to match the speed of Apple Pay. But turning around a ship this size is agonizingly slow. The company spent years buying random companies like Honey for $4 billion instead of fixing their core product. Chris is trying to trim the fat, but investors remain skeptical. The stock price in 2025 reflects a market that is waiting for results, not just press releases. They have replaced the leadership, but they haven't yet replaced the perception that PayPal is a legacy company fighting for relevance. PayPal's biggest failure was its attempt to become a, quote, super app. They wanted to be your bank, your stockbroker, your crypto wallet, and your coupon clipper all at once. The app became bloated, confusing, and heavy. Users didn't want a super app, they just wanted to pay for things. While PayPal was adding crypto trading and donation features, Cash App and Venmo kept things simple, and Apple kept things invisible. In 2025, the company is finally realizing that it needs to simplify, but the interface is still cluttered with upsells and credit offers. They forgot the golden rule of product design: do one thing perfectly. By trying to do everything, they excelled at nothing. PayPal is not dead yet. They still have over 400 million active accounts and process billions of dollars. They are too entrenched to disappear overnight. But they are transforming from a growth giant into a boring utility, a zombie company that exists but doesn't create anything new. The danger is that they become the AOL of payments. Everyone still has an account, but nobody actually uses it unless they have to. With active user numbers stagnating in 2025 and the stock price flatlining, the days of world domination are over. The users escaping to Apple Pay and Stripe aren't coming back. PayPal will survive, but the empire they built is history. PayPal's downfall is a brutal reminder that in technology, you are only as good as your last update. They took their customers for granted, ignored their competition, and broke the one thing that matters in finance: trust. Whether it was the misinformation fines, the frozen funds, or the clunky interface, they gave users a reason to look elsewhere. And once people looked, they realized they didn't need PayPal anymore. The king has lost his kingdom, along with his crown. Subscribe for more stories about the rise and fall of tech giants.